You think a bank is where you keep your money. It's not. It's a machine, and it runs best on the people who have the least. Here's the part everyone already knows. Banks take your deposit and lend it out to someone else at a higher rate. The difference between what they pay you and what they charge the borrower is theirs to keep. That single spread is roughly 80% of all bank revenue in America. Simple, obvious, not the video. Because if that were the whole story, the bank would just be a middleman. Take money from one person, lend it to another, keep the difference. But here's where it gets strange. The most profitable customer a bank has isn't the one with money in the account. It's the one who ran out. In 2025, banks and credit unions collected over $12 billion in overdraft and non-sufficient funds fees. Think about what that number actually means. Every one of those fees, by definition, came from an account that had already gone negative, not from the customer with a healthy balance, from the customer who didn't have enough, the people with the least funding the machine the most. And it's not evenly spread. About a quarter of American households pay one of these fees every year. They fall hardest on lower income households. This isn't a rounding error in the business model. It's a customer segment. Most people never notice this. Subscribe if you'd rather be one who does. Now, back to it. Let's talk about the size of the fee itself. The average overdraft fee nationally is around $27, but at many of the country's largest banks, it's still as high as $35 for one missed calculation, one coffee, one gas station stop, one auto pay you forgot about, and the moment you leave the building, it gets worse. The average fee for using an ATM outside your bank's network is now $4.86. A record high, the highest it's ever been, to take out your own cash. Here's the part most people never connect to the first part of this video. The money sitting in your checking account, the account you're not being charged to have, is earning you almost nothing. The national average interest rate on a checking account is 0.07%. Meanwhile, the bank takes that same balance and lends it back out at several times that rate. You are giving the bank a free loan. They just call it a checking account, so line them up. The bank profits on the spread between what it pays you and what it charges borrowers. The bank profits again from the accounts that go negative. And the bank profits a third time on money you never even see moving. 3 separate revenue streams running quietly on the same balance at the same time. Now here's the twist that makes this current, not historical. In 2024, regulators finalized a rule. It would have capped overdraft fees at $5, not $35, $5. The estimate was that it would save American households $5 billion a year. In 2025, Congress reversed it. And almost immediately, the fees came back. Citizens Financial, up nearly 17%. Huntington Bank, up 40%. M&T Bank, up 36%. One bank stands out more than any of them. USAA, the bank built specifically for military families, increased its overdraft fee revenue 471% since 2023, more than any other bank in the country. The banks say they haven't changed their policies. They're simply collecting more from customers who have less. So here's the full mechanism. The bank profits when you have money. It profits harder when you don't. And the one federal rule standing between the bank and that second profit got removed. The machine didn't need to change a single thing. It just turned back on. The trick is always in the numbers. And if a bank can quietly make money off the customers with the least, wait until you see what happens when one company owns almost every brand in your house. Most people never realize they're buying from the same company 8 times a day. That video's on the channel right now. You just learned what most people never will. See you in the next video.